Hello everyone, my name is Colin DeLoe. I'm the Director of Government Affairs for the Naperville Area Chamber of Commerce, and I'm here with the Illinois Director of the Americans for Prosperity, Andrew Nelms, and we're here to dive in a little more to this graduated income tax and what the effects can be here for Naperville. So, Andrew, if I can, talks have increased in Springfield on this topic. What is it? Can you describe what this process is?
Sure. So some have long advocated for scrapping the constitutionally protected flat state income tax and implementing a graduated one instead. And we're very concerned about that because, frankly, Illinois' flat income tax is one of the only bright spots on our tax horizon. We have currently we have the fourth highest corporate income tax rate in the country. We have a death tax. We have sales taxes. Lord knows we've got high property taxes. And so the thought of giving Springfield politicians greater latitude to levy higher taxes is obviously very concerning to us and I imagine to your members as well.
So besides the general idea of a graduate income tax, what specific proposals are out there? What exactly are we talking about right now in Springfield?
Right. So over the years, several rate schedules have been proposed, but just a few weeks ago, the governor proposed a rate schedule himself. And so that's really the center of conversation right now. And the governor's rate schedule proposes to raise about $3.5 billion in revenue by massively increasing taxes on, particularly on businesses, both large and small. The governor proposes to increase the corporate income tax rate to almost 10.5% once you include the personal property replacement tax, which would give Illinois the second highest corporate income tax rate in the country. And then he also proposes to increase taxes on small businesses that are operating as pass-through entities, which I imagine is the case for most of your members, because the governor proposes a top marginal rate of 7.95% on folks earning $1 million or more. In fact, in that bracket in particular, the governor's proposing what's called a recapture provision, where if you file with $1 million or more, all of your income is taxed at that highest rate, rather than just the incremental margin of income that's over $1 million, and that's something that only 3 other states do. But he also proposes increases in the rates in all the brackets along the way.
So I think that would be really surprising because when I talk to many people about this topic, they're focused, I think appropriately so, about their individual rates and what they're going to pay as a person. But you're saying as well, we are looking at in Illinois a raise of the corporate income tax rate as well as a raise to the rates if you're paying a pass-through rate, if you're set up as a pass-through organization.
Right, and the governor's proposal also maintains a flat corporate income tax rate. It does not graduate the corporate income tax rate. And so people would see a large increase in the corporate income tax rate, but then they also see an increase in what they pay as a pass-through entity, because the governor's plan purports to reduce taxes for the vast majority of folks. But I would say 2 things on that. One, nobody would be paying less than they were just a few years ago, before the permanent income tax hike of 2017. So in effect, politicians had to raise our taxes in order to pretend to lower them. And secondly, I'd say that I don't know that the rates the governor's proposing, even if they went into effect, would be in effect for very long, because it's my belief that rather quickly politicians would begin to add brackets and reduce the thresholds at which higher rates apply and raise rates, because again, this plan raises $3.5 billion in revenue. There's lots of folks out there that wouldn't be satisfied with $3.5 billion in revenue. They'd want 5, 6, 7, 8, maybe $10 billion in revenue. And so, that part's concerning to us as well. But the governor's plan also fails to double bracket for married couples filing jointly, so it implements a marriage penalty, and it's not indexed to inflation. And so that would result in something known as bracket creep, where over time, because of inflation, increasingly large numbers of people would find themselves bumped up into higher brackets only because of the inflation, the effect of inflation.
Yeah. So there's obviously a lot to this and a lot more that we need to talk about. So I know we're interested in diving into this issue further, and we'd love to run a program with you about that. So hope everyone stays tuned and continues to look at the programs that we have. So hopefully we'll go into this issue in a little more detail. Thank you very much.